Samson now to his presentation.
Okay. What I want to do in the next 20 minutes is really just hit on 4 key messages. First of all, when we think about financing social protection, but I want to think about programs that are very specifically aimed at reaching poor households. And in tackling the financing of this dimension of social protection, I want to argue we need to think about it in an investment framework. A decade ago, this was sometimes laughable. Evidence presented in South Africa was ridiculed by some international economists as fantasy because it presented the idea that social protection could actually improve economic growth rates. Today, that's a fairly mainstream idea. And whether you think about social protection as a human right, or as a handout, or as an instrument to change people's behavior, or as a path to development, regardless of how you think about social protection itself, when you think about financing social protection, it's very useful to adopt an investment framework. Second, I want to think about the costing of social protection. Because when you're in a country trying to influence policy and you have an idea for a social protection instrument, if you can't provide some sense of the cost, it simply can't be taken seriously. So I'm going to raise a few ideas in this third message about thinking about paying for social protection. And is it better to adopt a don't ask, don't tell approach? Or are you better off trying to figure out how to pay for it? And I'll tell a couple stories about that. But finally, the real message I want to drive home here is the idea from the title, For the Future, the idea of expanding and sustaining social protection, and how if we adopt this investment framework, we can look at the returns to social protection and see how the returns depend on how we embed our social protection programs within a wider development planning framework. There are 2 points to this graph. One is that there's enormous heterogeneity across the distribution in terms of what developing countries around the world are spending on social assistance as a percentage of national income. Many countries down here in the 0 to 0.25% range, and a few outliers like Mauritius, over 7% of national income spent on social assistance. But the real point is that the interquartile range, half the developing countries in the world are spending between 1% and 2% of national income. So if a country is at about 0.5% or even 1%, there's a lot of room to increase that spending and still have a lot of good company amongst the community of nations. But this contrasts with what rich countries spend. And these are the OECD countries. Now this includes social insurance, which is the lion's share, but for many developing countries, that's not a significant component of their social protection system. But the average is about 22%. There's been certainly a convergence over the past couple decades. And the exact numbers here, or the exact components, is not the point. The important point here is that rich countries invest heavily in social protection systems. And not just because they can afford to, but because they recognize the impact on the country's sustainability of their prosperity. My second favorite picture in the world is this microsimulation result. And to explain it, maybe we should erase these dark green bars and just focus on the light blue bars here, which are the poverty rates in some of the richest countries in the world. And we can see many of them are in single digits. France, Sweden, the Netherlands. But if we were to microsimulate using high-quality household survey data and take away all the social protection programs in the rich countries of the world, the poverty rates would look, well, like poverty rates in Asia and Africa. France here looks like South Africa, and Germany here looks like Indonesia. The difference between rich countries and developing countries, at least in terms of the patterns of national poverty rates, is the investment rich countries make in social protection. And maybe 50 years ago, a country could grow rich by harnessing unskilled labor into a manufacturing base. Or 100 years ago, South Africa with the minerals beneath its soil. Or 200 years ago, as Adam Smith wrote, with commerce as the source of the wealth of nations. But today, a college kid can type on a keyboard and generate a company with a market capitalization of $100 billion. Today, the source of the wealth of nations is right here. It's intellectual capital. It's the quality of our human resources. In countries that are facing a demographic dividend, a young population growing to support over time an increasingly aging population, we face an enormous investment opportunity. And that's the opportunity to invest in the long-term productivity of our human resource base and drive our future prosperity. That, I think, is the most important issue we need to think about as we contemplate financing social protection. I want to talk about a couple technical issues, but at a fairly high level. How do we cost these programs? And the ILO has costed a number of different options. And here we have a comparison of a basic pension, older people, people with disabilities, in some low-income countries in Asia and Africa. And what we see here is in some countries like Bangladesh, the costs are rising. In some countries like Nepal, the costs are flat. In other countries, the cost over decades is falling. And the calculation here is fairly simple. What's the percent of your population that's going to be covered by the program? And what's the benefit as a percent of national income? You take those two estimates, you multiply them, and you have an estimate of the cost of the program as a percent of national income. You can pay $100,000 to a consulting company to cost your program, or you can go pick out the population pyramids from the International Census Database and calculate probably the same number in about an hour. It's a simple calculation for any program. They're both policy variables. How will you set the benefit level? Should be scientific, but in almost every country of the world, it's a normative exercise. Benchmark that relative to per capita income. And then what's your projection of coverage? Again, that's a policy variable. How much are you going to spend? How rapidly are you going to scale up? Just express that coverage number as a percent of the population. In about an hour, you have a very credible estimate as a percent of national income of what your program will cost. That's what the ILO has done here. And then do it over time, which means how rapidly is your country's population growing, and how is demographic change affecting coverage? And how rapidly is your economy growing? In the case of pensions, if your country is aging faster than your country is growing, like Bangladesh, a pension has an increasing burden over time. But as Professor Asher pointed out, if you're looking at a much larger social protection system, well, the real driver of the cost of the ILO's basic package focuses on education and child benefits, which are a lot bigger a share than pensions for older people. And in all these cases, in every country, at least in low-income countries, but even more so in middle-income countries and rich countries, the share of the population that's children is falling over time with the demographic transition. And economies, by and large, are growing. So the cost of a basic package that's affordable today is even more affordable a decade from now, and 2 decades from now, as you benefit from economic growth and the demographic transition. It's important to be able to map out the cost today, at least in rough terms. You just need really a rough number here at the policy influencing stage, but you also need that estimate of how that's going to change over time. And as we've seen here, that depends on the kind of program. But the second question, how we should pay for it, well, that's a big question, whether you should even try to answer it. In South Africa, policy advocates of a more universal program were quite intent to quantify the cost and look at financing structures, including tax reforms necessary. And they hired a commission of economists who came up with 4 alternative proposals. And the policy coalition proceeded to fight amongst themselves until the proposal was marginalized. First of all, when you look at how to pay for it, the value-added tax, increased income tax, the corporate tax, reallocation from other government programs, you make a lot more enemies than you make friends. You intensify the rhetoric and the sense of cost, even around your base. But the second thing is, you don't want to tell either. We have people from Ministry of Finance here? Anybody here involved in tax policy? When the Education Ministry wants to expand their education system, and they want to tell the Ministry of Finance where to raise taxes to pay for it, you're not going to be very receptive, are you? They're kind of out of place. So when we talk about financing, yes, it's important to know what it costs. It's even important to demonstrate it's affordable. But from there, you don't really need to worry about how to reallocate existing fiscal resources. As a social ministry, even as a planning ministry, you don't need to worry about whether you pay for it by selling off public enterprises or borrowing, even though countries have borrowed billions of dollars to pay for social protection programs. Yes, in the long run, these programs will be paid for out of tax revenue. But how that tax revenue is mobilized is ultimately a decision of the finance ministry as part of the larger macro picture. The most important, and development partners are often catalytic, but development partners will not sustain a program over a long horizon. Ultimately, it's about political will. And political will is driven by a number of factors. One is affordability, but the other is the fourth message, that we can generate long-term developmental impact through these programs. And I want to just introduce a model South Africa uses, a model that we're seeing increasingly common in Asia. I think it originated in Mexico when the finance ministry was first put in charge of the Progressa and later Oportunidades program, and saw an opportunity to think about social protection as, yes, primarily a tool for tackling poverty and vulnerability. That's what it aims to do. But it also can achieve long-term developmental impacts. And South Africa has just launched its long-term national development plan. In countries like Thailand and Nepal and Bangladesh, we see a central role for planning in creating the blueprint for social protection, as it contributes not only to poverty reduction and tackling vulnerability, but also contributing to inclusive development. And this framework may be my second favorite picture. And this is just a prototype of the picture, just a simplified version. It's a kind of input-output matrix for those of you who were involved in economic planning back in the 1960s and 1970s. Kind of went out of style. Because back then, the inputs, which are the columns of the matrix, were things like steel and rubber and concrete. And the outputs, which were along the horizontal rows of the matrix, were things like cars and toasters and steel, which kind of circulated back in. It's kind of hard to read this. Some of you might be able to read it, but the way this is organized is inputs for government are strategies, policy strategies, like social protection. And outputs, other sectors are things like education or livelihoods or health. What matters then is how these inputs, these government interventions organized by sector, integrate to achieve key objectives of the government, like poverty reduction or social risk management, or economic growth. Now, even a decade ago, we had frameworks like this. They weren't written in matrix terms, poverty reduction strategy processes. And often the focus was, what's the right instrument for a specific objective? The idea is if you wanted poverty reduction, you look to cash transfers. You wanted to improve health, maybe you look to health insurance. You wanted to improve literacy, you'd look at the education sector. That proved a lot too expensive. It triggered very rigorous evaluations, randomized controlled trials that would look at a specific intervention, a specific objective, and what kind of impact the program was achieving. This framework works differently. It says, let's focus on intra-sectoral linkages. How, for example, can health insurance work together with cash transfers to better achieve objectives? Health insurance, social health insurance is great, except the poor often can't afford it or don't choose to buy it. Cash transfers are great, but $20 a month is not going to protect a poor household against a catastrophic health shock. Putting these two instruments together makes them both stronger. Likewise, they're what we call intersectoral linkages. And the important element of evidence here is how these different instruments generate returns for the government's policy program across a range of outcomes. We take a step back and think about the old approach to development planning. So clear this and kind of put it into calculator mode. Invest the equivalent of $1 billion in cash transfers. What's the return if we aim to achieve poverty reduction? Say it's $1 billion if you have a perfectly efficient program in terms of reducing the poverty gap. How does somebody in the finance ministry or any economist doing a cost benefit assess this financial opportunity? You pay $1 billion now, you get $1 billion later. $1 billion later means you have to discount it, which means the rate of return to this investment is negative. Look at what happens if we look at a health insurance. Here's the calculator. Invest $1 billion in health insurance. What do you get in terms of return in terms of health? Maybe $1 billion or maybe more. It's a very efficiently implemented system. Same negative return. But clear the calculator again. Think about investing in a way that maximizes intra-sectoral linkages. Invest $1 billion in cash and $1 billion in health insurance. Why will that work better? The cash transfers can help include the poorest households in the social health insurance program, broadening the base, improving economies of scale, and reaching the poorest for whom the returns to health insurance might be the highest. And the health insurance will improve the comprehensive impact of the cash transfers by providing more comprehensive protection, particularly against shocks. And then measure all the outcomes across the spectrum. A bigger poverty reduction impact, also a risk management impact that was previously ignored, and a health impact. Now, the real problem here is not just about how we finance social protection, but clear the calculator and think about the bigger planning problem for the government. How do you optimize the investments? Not just across the sectors that are here, but across all the sectors for which government needs to balance priorities. And what's the return? The return is generated across the whole spectrum of objectives. The returns are much, much greater for two reasons. One, interacting instruments in an optimal way improves their relative efficiencies. Cash transfers contribute to educational outcomes. They also contribute to livelihoods outcomes, but livelihoods interventions also generate returns for poverty reduction. Evaluating with a single intervention, single objective approach misses a lot of the impact combined interventions can provide. Now, this is hard because if you want to optimize, you need to know the right mix. And some of the most pressing questions a country faces: how do we improve nutrition? That's not a health problem. It's not a food security problem. It's not an education problem. It's not an infrastructure problem. It's all of these and more. And those kind of interventions are expensive. You try a randomized controlled trial with the 7 or 8 major interventions that must be interacted to generate impact, and you've got hundreds of arms of a randomized controlled trial and a rigorous evaluation of maybe millions of households. It never happens. You want to evaluate how the lessons from global graduation pilots can be applied, you have the same problem. 6 or 7 major elements of treatment: cash transfers, training, awareness building, coaching, access to services, the kind of asset. And randomized controlled trials cannot handle that kind of a question. It's a multidimensional question which needs a different kind of evidence. Now, there are attempts and there are methodologies for answering this question. The priority here is to build a better evidence base to understand, one, what combination of interventions are most appropriate to achieve these objectives, and two, how we're going to evaluate these. In South Africa, it culminates in a kind of macroeconomic forecasting model that looks, in this case, at 3 key variables. What's the government's investment in social protection? What's the country's growth rate? And how does that growth rate depend on social protection? And what's the poverty rate, or in this case, the poverty gap? And how does the poverty gap depend on both economic growth and the government's investment in social protection? As the government maps out its development plan, it realizes that a big push now, which it's been undertaken for about 7 years, in social protection has 2 major impacts. It brings down poverty now and in the future. And it's found it raises the rate of country's economic growth. And both of those 2 effects reinforce each other. Economic growth further brings down poverty. And bringing down poverty actually further increases economic growth. Now that's great for those who want pro-poor growth. It's also great for the Ministry of Finance, because both of those effects tend to bring down the cost of the social protection program over time. So the countries do not face an increasing burden, but rather a more affordable opportunity set. So I want to conclude just by hitting home those 4 key messages. 1, we need to think about social protection as an investment. 2, this investment's affordable, even in the lowest income countries of the world, in no small part because the 2 main components of cost, coverage and benefit size, are policy variables. 3rd, we might not want to get into detail on the core financing mechanisms, but we recognize they depend on political will. And that political will can be influenced by the recognition that embedding social protection within a broader development planning framework can contribute significantly and importantly to pro-poor growth and inclusive development. Thank you.